to just, bring home in terms of the key takeaways, because I think it's now time that we sort of wrap up. The critical part here is, we've said it a couple of times throughout the course of the pod, and that is supply is the enemy of capital growth. All right. So whenever there's additional supply coming in, and if there's a lot of it in a quick succession, that's going to put downward pressure on growth in those particular markets. And broadly speaking, the momentum in the market and the undersupply will continue for at least the next 3 to 5 years. I can't see any quick fixes that any government's going to be able to deliver to us. So we're going to see a significant undersupply, which gives us good confidence over the shorter term of the next 5 to 10 years that we're going to see that continued capital growth, subject to, the economies in those local areas continuing to grow. That's an important mechanism for making sure that value rolls through into residential property. We are definitely seeing that increase, in terms of where there's going to be pressure in those markets right now. So the Darwins, the Melbournes of this world, that's because of the poor economy, or a slowing economy, or an economy that's riddled in debt that we've got to look for.
Or an economy that's being interfered with.
Yeah, and then there's that sentiment story, and obviously we've been very, sort of anti-Melbourne and anti the government down here in terms, and that's definitely shifted sentiment around that particular market. And now that is going to be balanced up by boardless investors who are retail investors who are thinking medium to longer term, and they could, again, underpin that level of demand as they see really affordable land and improvements on that land down here in Melbourne and Victoria more broadly, the Geelongs of this world.
Well, it's a
They
market
are
cycle timing play, isn't it, really? Because if you had
correct.
all these markets that are going, getting all the headlines, and then you've had Melbourne that's coming off, and we'll talk to this point shortly, but as you have a look around the corner and eye to what might be the next form of stimulation, which will be eventually some form of interest rate cut,
Yeah.
and you've got choice in the Melbourne marketplace. I would be saying to folks that if you're coming off a lower base, there's evidence to suggest that the Melbourne marketplace is hitting some forms of bottom. If you combine that with choice, and then being in the asset selection lane with the eyes well and truly on what's probably going to happen in February or March of next year with respect to interest rates, that's I see that as a market cycle timing play.
Yeah, and I want to, in wrapping up, I want to congratulate those people who took action at the start of the year, like, our February update, and we've obviously done one in August leading into the spring season. Those people took action, and I think they will be rewarded over the medium to longer term in terms of the action that they've taken. And I think if they have found themselves in our big economic engine markets of Sydney or Melbourne or wherever they are, they're going to do well. Those who have also gone into those affordable markets, they've had some wonderful gains in this current period of time. That's great for equity and potentially rinsing and repeating. And, I want to congratulate them as well, because they're feeling pretty good about the investments that they've made over that medium to longer term. Those cities have still got to keep reinventing themselves. They've still got to be an attraction city to bring that population in. They've got to still keep that economic flywheel growing. And if they don't, those markets will again continue to subside and bottom out and stagnant for decades if they don't do the right thing from an economic point of view. And then, what we have seen is, because these interest rates have remained higher for longer, which I mentioned earlier in the start of this update, it has allowed this window to open up even further, where we are definitely, to your point, Bryce, in what we would call a buyer's market rather than a seller's market in some of those markets like Melbourne and some of our regional markets around Melbourne. And I think what we've then got to say to ourselves is, from a logical point of view, we just do the 5 whys. It's like, okay, well, what are the things that are going to increase the next level of demand? Well, the next level of demand is going to come predominantly from an interest rate cut, to your point, Bryce. And so the why is, and if we look at, we did see where Evan and I did the update last week, we saw the inflation data drop the day after. So I just wanted to quickly talk to that. So we're seeing the monthly inflation figure fall to 2.7. We've seen excluding the volatile items, that fall to 3. And then we're seeing the annual trim mean fall to 3.4. Now, it's the trim mean one that's the most important. And that's not in the band of 2 to 3%. And remember that Governor Bullock was basically talking about this idea that sustained She used that word a lot in the media conference
Well,
post that
energy
announcement.
rebates don't count, mate. That's not sustainable.
No, that's not sustainable. She will disregard the government rebates on energy, which has manufactured some of that fall. But all of the other indicators, again, are still moving in the right direction. But that's sustained story. So then we look at the 30-day intraday bank, and we're definitely seeing that there's an expectation that come February, the money markets are pricing in at least one rate cut by then. Now, if I was a betting man, I would say that the governor, being the Conservative governor that she is, and the board, that they wouldn't be looking at a December rate cut and stimulating the economy and risking that sustained inflation staying high, because we get out there and spend because we all get a little bit of extra money come these rate cuts. But certainly February, March, when we get probably the December quarter inflation read, if we get two of those quarters showing that trim mean is now within that band, remembering that there's a significant lag in terms of when you do drop the cash rate, it takes a while for that to improve supply of cash in the economy, the same way as it takes a while when you increase interest rates to put the brakes on and to slow that economic flywheel. So, that's an important story for me, is when I'm thinking about this little window that's being open, and this is sort of my what's making property news outside of the negative gearing story for next week, is that you do have that window. So if you're serious about owner-occupied purchase, or you're serious about upgrading, or whatever it is, you want to try and do that with the least amount of competition possible in some of those markets. So be counter-cyclical in those particular markets. You're still not going to be able to achieve that in Adelaide, Brisbane, or Perth, but think about what might happen even in those markets when you are looking to upgrade or downsize from an owner-occupied building, or if you're looking to invest in those markets. It's pretty clear that if we get a couple of rate cuts in the first half of next year, then you would logically think that would lead to a further increase in the level of demand that is then starting to look for property.